Hello everyone. These are indeed very challenging times for economic forecasting. At first, COVID-19 was largely downplayed by major governments around the globe to be only a regional epidemic. It has now, however, gripped the entire world's attention due to a very rapid and exponential spread. In this period, there's been a flurry of policymaker responses aiming to curb the negative impact of the lockdown on the real economy. And while lockdowns and social distancing measures are absolutely necessary for the containment of the pandemic in the initial stages and can limit economic losses in the long run, the large-scale isolation of populations globally has dire implications for economic activity in the short term. There is a heightened sense of uncertainty playing out around the evolution of the spread of the virus, and as a result, we have decided to approach economic forecasting by mapping out some broad economic scenarios which we see as plausible in the coming months. Now, there is obviously huge forecast risk attached to each of these scenarios, but we are trying to sketch out broad trends which could be helpful in terms of establishing a framework for what to expect in the coming period, particularly as economic numbers that are likely to be reported in the coming months are expected to be very poor and could cause a further negative reaction in global financial markets. Our first scenario under consideration: a V-shaped recovery, or what we will refer to here as the best case scenario. According to Harvard Business Review, most prior epidemics followed a typical V-shaped recovery. So these include SARS in 2002, as well as the H2N2, or what was called the Asian flu, back in 1958. This is a scenario in which the globe undergoes a rapid growth slowdown in the first half of 2020, but there's an equally rapid recovery that follows from the middle of the year. In this scenario, we assume the virus spread is contained by the middle of the year, either through some pharmaceutical breakthrough or just highly effective government measures in order to contain the spread of the virus. In this scenario, we assume that quarantines are lifted quite quickly and are not resumed later on. In this V-shaped recovery, you will still likely see massive intra-quarter volatility, but the annual rate will largely absorb the short-lived growth shock. The strong rebound in the economy is largely based off the premise of strong public health structures and highly effective policy responses. We show that even though growth outcomes bounce quite nicely into 2021, these growth outcomes are likely to remain significantly lower than the long-term historical averages, particularly when looking at the advanced economies. In a V-shaped scenario, growth in South Africa is likely to continue to suffer from electricity shortages, weak consumer and business sentiment, and the lockdown, which will add to the negative hit to discretionary spend and business output. We show that SA ends up with a sizable growth contraction in 2020 as both exports and domestic demand are hit. Now, with regards to inflation in South Africa, even though the rand is initially weaker, the plunge in international oil prices and very little rand pass-through from retailers to the end consumer likely means that inflation will stay well within the target band in the medium term. So this would leave the Reserve Bank with room to cut interest rates by another 100 basis points in our view in 2020. In this environment, South Africa's current account deficit ratio is likely to remain quite close to its long-term average of around 3%, but unfortunately, South Africa's fiscal deficit ratio is expected to deteriorate into high single digits. Revenue collection is likely to be quite strained in this scenario, and achieving the planned wage bill cuts may prove to be quite tricky. In this scenario, we see Standard & Poor's adding to SA's sovereign debt woes by downgrading South Africa even further. We outline our base case scenario, or what we call the U-shaped recovery. In this base case scenario, we consider a peak in the rate of COVID-19 related fatalities occurring in the third quarter of 2020. Global supply chain disruptions will likely linger in the third quarter and only start to fade by the fourth quarter of the year. Now, under this U-shaped recovery, all the efforts that have been made by central banks and governments globally are only likely to benefit growth from the fourth quarter of the year after lockdowns and social distancing measures are relaxed. We show that we expect global growth to sink to negative 2.3% in this scenario before recovering to 2.9% in 2021. Some areas in the economy are likely to experience a permanent loss in demand, such as tourism, the hospitality industry, and even the airline industry. However, other discretionary spending sectors, such as cars or furniture, could see a deferral of demand until after the crisis. Although there are signs that activity is resuming in most regions in China, inventories are still likely to be quite low, and there may still be a shortage of critical inputs. The difficulty in determining the timing as well as the extent of that demand rebound may also send very confusing signals to the manufacturing sector for some time yet. You can see that the hit to growth is much larger in 2020, particularly in the United States as well as Europe. In our base case, we also assume a significant hit to growth in South Africa. We show that growth is likely to contract by around 5% in 2020 on the extension and the lockdown. Very muted confidence levels will weigh on the consumer as well as on investment spending, while weak global demand will continue to stifle export growth. Even though the weakness in the currency is set to persist for a little bit longer in our base case, demand remains very fragile, and as such, retailers will remain hesitant to pass on the costs of a more depreciated currency. We expect inflation to average around the lower end of the inflation target band in 2020 and to remain well within target in 2021. We would also expect the Reserve Bank to cut interest rates more aggressively in 2020 and 2021, leaving interest rates at around 3% by early of next year. Now, with lower demand compressing imports, we would generally expect a narrowing of the current account deficit, but pressure would remain very high on South Africa's fiscal deficit, which is likely to climb into the early teens in this scenario. We would also then anticipate further downgrades by the three major rating agencies, but on a staggered basis. Moving over to slide 8, we have also considered a bear case scenario, which we call the protracted U or W-shaped scenario. Now, in this bear case scenario, we assume that there is a second wave of COVID-19 that flares up across the globe. This would mean that quarantine measures are extended to more regions and extended for longer. This scenario could also entail new cases emerging in other parts of the world, which could drag out the peak in global infection rates. In this scenario, we would see global supply chain disruptions re-emerging, and this would prolong the downturn in local demand as well as exports. Ultimately, this would affect corporate profitability very negatively, and we would likely see corporate credit risks rising as a consequence. We highlight a range of potential growth outcomes under this protracted U or W-shaped scenario. Looking back at history, we have seen a protracted U-shaped recovery in the 1970s in the United States, when unemployment and inflation remained high for a number of years. Similarly, the United States economy experienced a double dip, or what we call a W-shaped recovery, in the 1980s. Now, in this scenario, the negative growth outcomes for the United States and Europe, as you can see on slide 9, are quite extensive. A higher disease burden would place their healthcare systems under significant strain in this scenario. Supply chain disruptions would be more extensive, and a much wider range of the economy would be impacted. The downturn in this bear case scenario would be prolonged. This would force governments and central banks to step up their stimulus efforts, but households could remain wary of spending on discretionary items and may even opt to increase their savings instead in this scenario. Firms would likely delay investment spend and would be hesitant to hire new workers and may even shed a large number of their current workforce. As such, the global economy then suffers under second-round effects from the virus outbreak. Slide 10 shows you that this type of bear case scenario would be quite dire for South Africa, and here we would expect a contraction in growth of around the order of 7.5% in 2020 before staging a very mild recovery into 2021. In this scenario, business and household spending takes much longer to recover, while prolonged weakness in the globe would translate into weaker exports for much longer. Now, even though the rand is expected to remain on the back foot in this scenario for both 2020 and 2021, demand is so weak that inflation remains subdued. The Reserve Bank in this scenario would be forced to consider deeper cuts in the interest rate. In our view, the current account deficit would narrow significantly in this scenario as imports start to compress on very weak demand. However, South Africa's fiscal deficit would soar into the high teens on much weaker growth outcomes. Further, sovereign rating downgrades would also follow a lot quicker in this scenario. Lastly, we consider a tail risk scenario, which we call the L-shaped recovery, but this holds a very low probability in our view. In this scenario, the spread of the virus continues for up to a year, policy responses prove largely inadequate, and we enter what we call a new normal. This outcome would be very similar to the Great Depression, where a much deeper and much longer recession results in firm bankruptcies and wide-scale employee layoffs. So, how do we handle investments at a time like this? While investment returns will be negatively affected in the short term by this destructive effect of COVID-19 on growth asset classes, history has actually shown us that long-term returns are largely unaffected by these kinds of events. As such, we encourage all our clients to stay invested throughout all market cycles, rather than to try to attempt to time markets at a time like this when there's a virus outbreak. Although investors often feel the behavioral urge to at least do something to their portfolios during uncertain times, history has provided us with the most prudent and lucrative investment strategy to actually stay invested. Thank you for your time and good luck out there.